Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Okay, let's just look at the tape. Roku closed the session on January 27, 2026 at 104.58. That was down about 2.25%. But the slide didn't stop there. By January 29th, the stock had drifted all the way down to $100.46. And while all this was happening, the S&P 500 gained 0.41%. And the NASDAQ, the tech index, added almost a full percent. Roku just completely decoupled.
And that decoupling is everything here. It's not just noise. The broader market was rallying, and Roku was, well, it was being sold off. But look at the participation. I mean, the volume on that drop drifted lower than the 30-day average. So we're looking at this classic divergence between the price action and the actual participation. So I think the central question we're debating today is pretty simple. Is this idiosyncratic selling pressure a major warning sign ahead of the February 12th earnings? Or does that quote-unquote hammer chart pattern from January 30th signal a real technical bottom for a company that is, fundamentally transitioning into an ad tech superpower?
I'm taking the side of the pivot. I really believe the market is mispricing this asset based on, frankly, backward-looking hardware fears.
And I'm taking the other side of that. You see a technical bottom, I see a structural decline. I think that price weakness isn't a glitch. It's the market waking up to the fact that Roku's moat is drying up.
My thesis is pretty straightforward. The market is pricing Roku like it's a hardware company facing these retail headwinds, specifically the whole Walmart situation, which I'm sure we'll get into. But they are totally ignoring the reality that Roku has successfully pivoted. I mean, this is not a dongle company anymore. It's a high-margin advertising platform. If you look at the consensus EPS, the earnings per share estimate for fiscal 2025, it's risen 2.21% in just the last 30 days. It's now at 32 cents. We are talking about a definitive shift into GAAP profitability, and the smart money sees this. On January 30th, despite hitting new intraday lows, we saw significant support step in. The stock formed a textbook hammer pattern.
Can we just pause on that for a second, just to visualize that for listeners who aren't technical analysts?
Sure, yeah. A hammer candle looks like a T or a hammer on the chart. It means the stock opened, sellers pushed the price way, way down during the day, trying to break the trend, but then the buyers just stormed back in and closed the price right near the very top of the range. That long wick at the bottom represents rejection. That rejection of the lows, to me, says the bearish momentum is exhausted. I mean, Simply Wall State's two-stage free cash flow model suggests an intrinsic value of $182. We are trading at a 45% discount to fair value because the market is staring in the rearview mirror.
I appreciate the optimism, I do, but I look at the same exact data and I see a totally different story. I call it the ecosystem squeeze. So profitability is a nice headline, sure. But I just don't buy that it justifies the current valuation when the company is being physically, displaced from the living room. You mentioned the decoupling from the NASDAQ. That is not an accident. That's the market realizing that with Walmart acquiring Vizio, Roku is losing its primary distribution channel. And as for that hammer pattern you're celebrating, it happened on low relative volume. That's not conviction, it's apathy. The stock is still down 9.3% over the last 30 days. And when you look at the valuation, we are sitting at a forward price-to-earnings ratio of 86.68. The industry average is 12.28. You are paying a massive premium for perfection in a market where the world's largest retailer is actively dismantling your hardware advantage. That isn't a pivot.
That's a defensive crouch.
Okay, I want to pick up on that ecosystem squeeze comment because this is really the heart of the bear case. You're talking about the Walmart-Vizio merger.
It is the absolute elephant in the room. We have to address it. Walmart acquired Vizio for $2.3 billion back in late 2024. And now here in early 2026, we are seeing the reality of that deal. They have aggressively integrated Vizio's SmartCast operating system into their on-brand televisions. And for years, those on TVs were Roku TVs. I mean, that was Roku's bread and butter, cheap hardware sold exclusively at Walmart that got their OS into millions and millions of homes. That shelf space is gone. Walmart effectively evicted Roku from its largest OEM partner. Roku doesn't need Roku's OS anymore. They want to control the entire stack. the hardware, the software, and, most importantly, the ad inventory through Walmart Connect.
I agree that on the surface, losing that exclusivity on the on-brand is a blow, no question. However, you have to look at how Roku hedged against this exact scenario. While Walmart is pushing Vizio, Roku still retains a massive data-sharing partnership with Walmart Connect that they set up back in 2022. So they are still part of that data ecosystem. But honestly, relying on Walmart was yesterday's strategy. Roku has doubled down on Best Buy with the exclusive Roku-branded Select and Plus Series TVs, and that partnership includes first-party shopper data from Best Buy.
But let's be honest about the Walmart relationship now. It's gone from a partnership to, well, competitive friction. Why would Walmart ever prioritize Roku's ad inventory when they can sell their own, directly through the TV they manufactured and control?
Because Roku still controls the engagement on the massive existing install base. But more importantly, you are focusing on the old hardware Trojan horse strategy. That war is over. The new war is the Amazon DSP integration, and this is arguably the most important deal of 2026, and I think the market is completely underestimating it.
The Amazon DSP.
Yes. DSP stands for Demand Side Platform. It's the software that advertisers use to buy ads automatically. By allowing Amazon's DSP access to Roku's 80 million households, Roku has basically prioritized revenue liquidity over platform exclusivity. They are letting Amazon buy inventory right on Roku devices.
That sounds like a surrender. You're handing the keys to your inventory to your single biggest competitor?
It is not a surrender. It's solving the single biggest problem in connected TV advertising, which is closed-loop attribution. Let me just explain what that means. Historically, if I saw an ad for, say, a blender on my Roku TV, the advertiser had no real way of knowing if I actually went and bought that blender. It was a total guessing game. But by plugging into Amazon, they bridge that gap. Roku shows the ad, Amazon tracks the purchase on their store. Early tests of this partnership are already showing a 40% increase in unique reach, and this is critical, a 30% reduction in ad repetition.
Yeah, and ad repetition is a plague. I swear, if I see the same insurance commercial one more time, I might throw the remote through the screen.
Exactly. And that just ruins the value of the ad slot. By using Amazon's deterministic shopper data, Roku can finally fix that frequency copying. They're projecting that 50% of streaming advertisers are going to redirect funds from social media to CTV in 2026 specifically because of this. Social media right now is just AI cluttered. It's full of bots, fake engagement. Roku offers a verified human eyes on the biggest screen in the house with proof of purchase attached. That is the holy grail.
I'll concede that closed-loop attribution is a powerful narrative. Advertisers, they love data. But I have to bring us back to the price you are paying for that narrative. You mentioned an intrinsic value of $182 earlier. That assumes a growth trajectory that I think is seriously threatened. Let's talk valuation benchmarks. You're pricing Roku like it's big tech. It trades at a price-to-sales ratio of 3.28x. Okay, sure, that looks cheap next to Apple at 9 times or Amazon at 4, but is Roku really a tech giant?
It's a software platform.
But without sticky IP. They don't own the content. Roku is a middleman, a distributor. If you benchmark them against companies that actually control the content or the venue, like TKO Group, which owns the UFC and WWE, or Live Nation, the comparison just falls apart. TKO is trading at a price-to-sales of 9.12x because they own the IP. Roku owns the menu. And if the menu becomes less relevant because Walmart and Vizio are pushing their own menus, then that 3.28x price-to-sales isn't conservative, it's a value trap.
I think that comparison is flawed. I mean, you don't value the cable company based on the shows. You value it based on the subscriber base. And Roku's base is massive. Look, Evercore ISI just upgraded Roku to outperform with a $145 price target specifically because of the platform revenue acceleration. They aren't valuing it as a hardware company. They are valuing it as a gatekeeper. And regarding the content argument, you're missing the macro tailwinds. 2026 is shaping up to be a super cycle for advertising.
Events are temporary.
But the cash flow they generate is very real. We have the FIFA World Cup in North America, the Winter Olympics, and the U.S. midterm elections all happening this year. These are massive drivers for ad spend. Morgan Stanley raised their 2026 U.S. ad growth outlook to over 10%, and they specifically cited the digital transformation of local ad spend. Roku is uniquely positioned there. I mean, a local car dealership can't afford a Super Bowl ad on linear TV, but they can target just their zip code on Roku during the World Cup. That macro environment supports Roku's internal projection of 19% platform revenue growth. If they hit 19% growth, that PE of 86 compresses very, very quickly.
That is a very big F. If they hit 19% growth while losing the Walmart channel, I'll be impressed. But I want to pivot to something that has me very concerned, especially in the immediate term. We need to talk about what's happening in the dark pools.
Okay, right. Let's just explain dark pools for the audience. These are essentially private exchanges where institutional investors, the whales, can trade stocks away from the public eye.
Correct. They use them to move huge blocks of stock without causing the price to spike or crash immediately. It's where the smart money hides its moves. So we talked earlier about the volume drying up on the lit exchanges, the public Nasdaq feed. On January 30th, the day you saw that so-called hammer pattern, the dark pool volume in the after-hour session was 41,000 shares. The volume on the public exchange, about 4,400.
Wow, that is a significant discrepancy.
It's not just a discrepancy, it's a signal. That's a massive concentration of volume in non-lit venues. It strongly suggests that large block trades were being executed by institutions who wanted to hide their exit or, reposition without triggering a public panic. And when you pair that with the insider selling, the picture gets even darker. We have CEO Anthony Wood, who has sold approximately 350,000 shares over the last 6 months. The CFO, Dan Jetta, was selling in December and again on January 15th. I mean, if the super cycle is so obvious and the stock is so undervalued at $100, why are the people running the company cashing out?
I see why you'd flag that, but we have to be precise about insider selling. You know as well as I do that these are Rule 10b5-1 plans.
They are automated, yes, I know.
Right. They are prearranged sales for liquidity, for diversification. Executives create these plans months in advance. Anthony Wood can't just wake up, see the Vizio news, and hit the sell button. These plans were likely set in motion way before this current price action. And despite those sales, insiders still own about 14% of the company. That is a huge alignment with shareholders compared to most tech mid-caps. If they were truly abandoning ship, that number would be much, much lower.
It's still $42 million worth of stock hitting the market in 90 days. That creates headwinds.
True. But look at who's holding the other side. Institutional ownership is at a staggering 89.48%. FMR LLC, that's Fidelity, is sitting there with over 19 million shares. Vanguard has 13 million. Even Cathie Wood at ARK Invest is still holding Roku as a top position. If there was a true exodus happening in those dark pools, you would see these ownership numbers dropping off a cliff in the 13F filings, but the top holders are largely maintaining their core positions. And also, look at the short interest. It's only 5.97%. The days to cover is 2.42. This is not a crowded short trade. If the bears were so confident that the Walmart news killed this company, short interest would be double digits easily.
Or the smart money has just found a new way to bet against the stock without shorting it directly. And this brings me to the most fascinating piece of data we've seen this week, the correlation with prediction markets.
Prediction markets? You mean like betting on elections?
Exactly, but applied to finance. We're seeing this new phenomenon in 2026 where whales are using platforms like Polymarket to hedge their equity positions. And there's a distinct correlation. That 6.3% cumulative drop in Roku's price in late January coincident perfectly with a spike in activity in tech-heavy prediction markets. Blockchain analysis shows wallets, likely institutional, moving into prediction contracts that hedge against tech volatility. They aren't shorting the stock and paying interest to borrow shares, they're buying downside outcomes on prediction markets. It suggests the smartest money is betting on volatility or a downside surprise on February 12th.
That is a compelling theory, but I view prediction markets completely differently. I see them as information hubs, not just casinos. I mean, look at the Netflix earnings back on January 20th. Polymarket correctly predicted the ad-supported mentions and the partnership mentions on the call. The market signaled the pivot before the call even happened. For Roku, I actually see this technology as a massive opportunity. You know DAZN just signed that deal to integrate real-time prediction probabilities into live sports broadcasts?
Sure, for in-game betting probabilities.
Exactly. And who is the hub for sports streaming? It's Roku. If Roku integrates similar interactive features, wagering-adjacent apps during the World Cup or the Super Bowl, it unlocks a completely new revenue layer. Imagine watching the game and using your remote to interact with a prediction poll overlay. Roku takes a little toll on that interaction. The regulatory risk falls on the app developers, not the platform. Roku just collects the rent. So when you see activity on Polymarket, I don't see it as a hedge against Roku's failure. I see it as a signal that the wagering-adjacent demographic is active, and Roku is the absolute best place to monetize them.
That is incredibly speculative. You are banking on them monetizing a feature they haven't even announced yet to justify a PE of 86, all while their actual hardware sales channel is under siege.
No, I'm banking on them monetizing the 80 million households they already have, using the best ad tech in the world via Amazon. The interactive features are just the cherry on top.
Okay, let's bring this to a head then. We are less than 2 weeks away from earnings. You have a stock trading around $100. You've got a hammer pattern on the chart, but you have this dark pool selling in the background. Where do you stand?
I stand on the side of the pivot. That hammer pattern on January 30th represents the market finally pricing in the Walmart risk. It's done. The sellers who were scared of Vizio have left the building. What is not priced in, though, is the Amazon DSP upside and the massive ad supercycle of 2026. If you believe that simply Wall Street's intrinsic value of $182, and I think the cash flow growth justifies it, then buying here at around $100 is a no-brainer. The downside is limited because the expectations are already reset, but the upside on a margin surprise is just massive.
I'm sorry, I just see the opposite. The technicals, specifically that dark pool variance and the lower relative volume on the drop, tell me there is zero conviction in this buying. The strategic loss of the Walmart hardware channel is a structural break in the thesis, not some temporary headwind. You cannot be the OS for the living room if the biggest retailer in the world kicks you out of the living room. And with a forward PE of 86, there is absolutely no room for error. If they miss on guidance, or if that platform revenue doesn't show the Amazon bump immediately, that $100 level isn't a floor, it's a trapdoor.
Well, we won't have to wait long to find out. The critical watch item for everyone is going to be that February 12th guidance on platform revenue margins, specifically if they can show that they are on track for that 10.8% adjusted EBITDA target.
Agreed. If they hit the margin target, the bulls might have a case. If they miss, the dark pools win. The market will decide on February 12th.
Indeed it will.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.